Tiger, as April comes to a close, we're going into what are often the dangerous summer months for stocks.
Yeah, that's right. I mean, we did a story this morning, my colleague and I, Tom. We're not saying stocks are going to collapse. We're not saying things are going to be terrible. But what we are saying is that...
So what are you saying, John?
What we are saying is that, you're right. April, if we finish positive today, it's going to be the 7th month in a row of gains for the Dow. That's something we haven't seen in 5 years.
That's a pretty incredible streak.
That's quite a streak. And we're now entering the more difficult months here. I mean, a lot of investors remember 2010, 2011, and this old saw that they say, sell in May and go away. And as you know, May is on the doorstep here. Typically it means the end of May, but there's some concern that perhaps we get a little jump on that because the earnings picture right now for corporate America, it's been good, it's been robust. This past quarter has been a good one, but still a lot of worries out there.
It's interesting you mentioned 2010 and 2011 there, because if you think back, 2010 got off to a great start.
Right.
The first quarter is fantastic, and the next thing, Europe comes along, it was Greece.
Right.
Last year, same thing. Stocks doing fantastic in the first quarter. Then we had Europe. Then we had the debt debacle. Then we had the S&P downgrade. Then we had Europe all over again. What disaster is looming this year?
Well, the other thing that's lurking, that lurked last year and could be another factor this year, is that QE2, the second round of easing from the Federal Reserve last year, faded around this time. I mean, I think it was June, last year.
Right, it was June last year that the second round of bond buying ended.
Right, and we have Operation Twist. That's sort of QE 2.5, people say. That's slated to end in June again. So it puts us in a similar
Let me just explain
position.
one moment there what Twist is for our viewers. This is where the Federal Reserve takes its massive holdings of Treasury bonds and sells the shorter dated ones, buys the longer dated ones, so 10 years and 30 years, to try and keep long yields down.
But effectively, it's to help the economy, and that help is running out in June this year, as it did last year. And you got a lot of those same issues in Europe still there. It's not Greece that's the focus this time. It could be Spain. It could be Italy still. It could be a number of these other countries here. But clearly that uncertainty is still there. And I think the concern here is that if we start to get a little bit of slowing down here, given all the gains that we've had this year, and given memories of the past 2 years, it's probably going to be a tougher slog going ahead here.
And it's also a case, I guess, where earnings, while they were good in the first quarter, the pace of earnings growth is slowing down when you compare to 2011, 2010.
And especially when you strip out Apple, the earnings
it's the Apple effect.
The Apple effect. Then it starts to look like just really modest growth here. And look, growth is better than recession, is better than
right. Growth is better than no growth.
That's right. But on the other hand, it may not be enough to help us really plow through some of these concerns that we have, because earnings has really been the driver of the rally that we've seen since the bottom in March 2009. And we've seen valuations come up in the last quarter. That's a good thing. But I think there's some concern about whether or not those are robust enough.